Okay.
I think we're live. Yeah.
And can everyone hear me okay?
Yeah.
Good.
Okay, perfect. We'll give everyone just one more minute to join. We'll go ahead and get started. Okay, well, welcome everyone. Thank you so much for joining us today for our webinar. Today, we'll be covering tax-efficient hedge fund strategies and management company taxation. We have our esteemed colleagues here from Acorian, Harborstone, and our own partner, Alex Cummings here as well. So my name is Anna Miller, and I will be moderating today's session. We're really excited to bring you this information today. We'll be talking about some of the essential tax strategies and hedge fund management and how you can optimize your approach for long-term success. But before I dive in, let me just go through a few quick housekeeping items. So first of all, this session will make you eligible for CPE credit. To qualify for it, all you need to do is answer at least 3 of the 4 questions that will be posed throughout the session and attend for at least 50 minutes. So we really encourage you throughout this whole webinar to ask questions, and you can use the chat to go ahead and chat with any of the panelists here. In addition, the program level here is really just basic. There are no prerequisites or preparation required. And we're going to go ahead and just dive right in. All right, like I mentioned, our panelists here are Alex, Vince, and Ryan. And I'm going to have them go ahead and introduce themselves and a little bit about their firms. All right, Alex, you want to start?
Sure, sure. Yeah, so I'm the tax partner in charge of the group here at Akram. Akram's a boutique firm with offices in 4 different states here in the U.S. and an office in South Asia as well. Our focus is primarily the alternative investment space, hedge funds, audit and tax, management companies, high net worth individuals, family offices that are associated with the investment world as well. So, you know, we're going to prepare about 160 to 170 fund tax return audits this year and other related returns.
All right, Vince.
We're in the middle here, so I guess I'll go next. Good to be here. Thanks, everybody. Yeah. Vince Calcagno, head of U.S. growth for Acorian here in the United States. In the U.S., we're in 7 offices: New York, Philly, Charlotte, Chicago, Dallas, San Francisco, LA. But we've got close to 30 offices globally. That's 21 countries that we're operating in. And we really specialize working with asset managers and owners with respect to their investment management business across the entire private fund spectrum. My own background, I've been an audit partner, moonlighted as a tax consulting partner. I've also spent significant time on the buy side in the CFO, COO seat for investment management businesses. So happy to be here to contribute today. Thanks to the team at Akram.
Okay, and my name is Ryan Carling. I'm from Harborstone Point Advisors, and we provide general tax, accounting, and business advisory services to all clients. And I have about 22 years in public accounting experience and 3 years as a CFO for a prop trading firm in New York.
Great, thank you all so much. Okay, so again, just very top level, some of the things we'll be covering off today. So key year-end tax planning opportunities, again, for both hedge funds and for management companies. We'll talk a little bit about structuring considerations to make sure that you are optimizing all of your after-tax returns. The team will also provide some updates on carried interest, management fee waivers, and pass-through entity taxation. And then just overall provide some additional strategic insights that will support compliance and reporting as some of these new regulations take effect this year. And at a high level here, again, the agenda. So these are the key 8 topics that we'll be talking about for hedge funds. And again, we'll have similar high level topics that we'll be talking about management companies as well. I'm not going to go into these in detail because we've got the panelists that will talk about these all individually, but this gives you a snapshot of some of the areas of focus for today. All right, with that, Alex, I'll turn it over to you.
Okay, great. We start with this topic. One of the things that we talk about with a lot of our clients this time of year, people are wondering, what should they be considering or thinking about at year end to make sure that they're doing the right things for their investors, and to the extent that they're invested in the fund or they're going to earn a carry, like what are the things they should think about with for tax efficiency. So one of the things that I think is important to look at is for the manager to kind of get a picture of this really applies to like our equity traders or long-term equity funds, things of that nature, but it can't apply to any fund if we just look at the difference between sort of what our book income is and what our year-to-date taxable income is. And a lot of the investors, of course, are focused on their book return. So having a good year and the fund's up 20%, and seeing investors up $50,000. If the taxable income is $50,000 or less, they're happy, right? So it's good to sort of look at your year-to-date realized gains and losses, including considering things like wash sales, to see how far off are we. And sometimes the portfolio will have like unrealized losses and positions that the manager thinks is worth staying in, but that is bringing down the NAV. And then on the realized gain side, we might have a lot of good performance there, and you could end up in a situation where taxable income's a lot higher than book. So it's important to look at those unrealized loss positions and make a determination, should we do some tax selling? With tax selling, you have to be mindful of the loss sale rule. If you sell a position to recognize a tax loss, you won't be able to re-enter that position for at least 30 days before or after that sale. And if you do that, that loss that you think you recognize is now going to be temporarily suspended, and you won't get the benefit of it. Another way to sort of achieve exposure in the portfolio, if you have that situation, is some managers will look at other stocks or ETFs or baskets of stocks that are representative. All other things being equal, will allow them to participate in that sector. And say we're down a lot in Pepsi, we might sell that and buy Coca-Cola to avoid that wash sale rule and be able to take that loss. The other thing to think about is if we have a unrealized loss position in a security and we're getting close to that 1-year mark, some managers will take the step of selling it before it gets to be long-term and then reacquiring it so that we reset the holding period. The reason for that is if you end up selling it after it gets to be long-term, to the individual investor, long-term losses will offset long-term gains first. That ends up being tax inefficient. So that's just a couple of thoughts there on how to think about looking at the portfolio year to date as we get near year end, and some ways we might be able to free up some taxable losses for the investors.
I think I would just add to that, I do have situations with clients where you also look at, maybe they're in a loss position and there's, a chance for them to sell some of their gain positions if they're looking to get out of them, and therefore not pass through large capital losses to investors as well. That could end up getting suspended. So it could be an advantage if you want to basically get rid of some of your positions and that's where you're at. You could recognize those capital gains.
That's true. Good point. You absorb some of those losses that you generated with gains.
Yeah.
Okay. Awesome.
So miscellaneous itemized deductions. So under the Tax Cut and Jobs Act, individuals were no longer allowed deductions for miscellaneous itemized deductions for the years 2018 to 2025. It's important to kind of watch that going forward, because as of January 1, 2026, this is no longer the case. So for a lot of investors, high net worth individuals, especially hedge fund clients, hedge fund managers, this really didn't apply because you were capped at, you can only take a deduction for portfolio deductions in excess of 2.5% of AGI. So that really wasn't an issue. But there are some situations where it could be deductible to investors. So this was a concern when the TCJA was passed in 2017. So there were a lot of funds that, kind of looked at this and tried to find a way, around this to, possibly classify expenses to capitalize them, recharacterize them, or report them in a more efficient manner. So, I mean, I think some of the ways that this was done is like management fee waivers. Alex, I don't know if you saw that much with a lot of your clients. I know there was some concern of whether, that would be considered a valid, waiver.
Yeah. I think that was something that was talked about some number of years ago. It hasn't come out as much. One quick correction here. I wanted to this actually it's important to watch for possible legislation before the end of 2025. This actually was impacted by the One Big Beautiful Act.
Yeah, sure.
Yeah, so apologies to the crowd here. I had updated this slide, but it looks like it didn't get to the final revision here. But effectively, that's been made permanent, right? So the point that Ryan brought up, pre 2018, investor funds the investors could get some benefit of those expenses. To the extent that it exceeded 2%, as you already stated, and then there was this period of time from 2018 to 25 where it was non-deductible, and that's been made permanent now. So this is still a concern for all investors and hedge fund clients. We'll talk about investor trader a little bit as well. So investor funds, which are generally your private equity or your funds that are investing for a longer term holding period, those fund expenses are going to generally be non-deductible, and as a manager, it's just important to understand that anything that you can do to minimize those expenses to the investors or structure it in a way that, that expense is going to a corporation, you'll get the benefit of it there. There's some trade-offs. It's sort of very tax inefficient. As a trader, these expenses will be classified as ordinary and deductible and no limitation. Just something to keep an eye on.
Yeah, I think in practice, I saw many funds where, they would reduce if they were not, their activity didn't rise to the level of a trader, they would charge a reduced management fee and a higher carried interest or performance allocation. And the benefit of that was you reduce the portfolio deductions passed through to your investors. And in turn, ultimately you get the deduction, those investors will get the deduction through reduced performance from the fund.
Awesome. And if you could bring us to the next slide.
For the next one?
Yeah.
Yep.
Yeah, thanks. Awesome. So one of the things, that there's as I mentioned on the last slide, if you have the ability to put a corporation in a structure, that'll help with a portfolio deduction issue. One of the things that a lot of U.S. investors are not aware of is that a lot of funds will offer, an onshore fund and an offshore fund, right? And typically your onshore fund is for U.S. investors and the offshore fund is for U.S. tax exempts and non-U.S. persons. But for a U.S. taxable investor, if you can go into the offshore fund and that fund is eligible to be treated not as a CFC, which has to do with control foreign corporation, which has to do with ownership, and they'll give you some tax reporting. Any expenses that would have been non-deductible as a portfolio deduction through a U.S. hedge fund, onshore hedge fund, will get absorbed in the other income. So you actually get the benefit of those deductions. There's a few other trade-offs that are important to work through, but that difference can be meaningful. If your expense load is 3% or something of NAV, over a 10-year investment period, it's quite a lot that is being lost, and you don't get a deduction for it. The other thing that's a pretty cool provision is that if you are leaving that money in the fund for a long time, you can actually make an election to defer the paying of tax on that as long as you don't bring those funds back on shore. You don't take a redemption. So there's an interest charge there. The IRS will charge an interest charge, but let's say the fund is compounding at a 15% tax rate and the interest charge is 7%. If you can defer the payment of tax on whatever you're earning out of the hedge fund for 10 years, and then when you pull that money back in at the end of 10 years and that deferral, you're going to pay that 7% interest rate. That the impact of being able to compound that tax rate for that period of time, you'll have a much larger investment. So that's a pretty interesting strategy, especially for high net worth investors or family offices. If they know that they're going to have a money with a manager for a long time, they have an offshore fund and they can take advantage of it. They get to save on the tax expense on the portfolio deductions and compound the after-tax pre-tax return and put a lot more at the end of the day. The other quick thing to just point out is,
if I can jump in real quick, I guess
Sure.
one aspect from the passive foreign investment company, the way the PFIC rules are, it's so that, the reason you're able to get the benefit of the portfolio deductions is because there's two components in PFIC income when you're calculating taxable income. The first component is PFIC ordinary income, and the second component being PFIC capital gains. So anything at long-term capital gains rate, like we'll go into with section 1256, 60% of that's long-term. Any long-term capital gains that goes into the one bucket of here's your PFIC long-term capital gains and is passed through to the investor, whereas the other bucket is just everything that's ordinary. So for purposes of PFIC reporting, all your ordinary income, the 40% of the section 1256, as well as any short-term capital gains tax, since they're taxed at ordinary rates, that's the one component is ordinary income. And then any expenses, be it ordinary expenses or portfolio deductions, in this case, they're considered ordinary and necessary at the PFIC level. So you're able to group that into the ordinary income number. So you can essentially net it there. So that way, when you pass through the PFIC statement, those investors are getting the benefit of those portfolio deductions.
And Ryan and Alex, correct me if I'm wrong. I think the one thing we typically just warn in that first year, right? If you start out in a loss position, those losses get deferred to the end. You can't net them in the next year if you have gain. It's kind of this quirky part of the regulation, right?
Yeah, so with the PFIC rules, if there's a loss passed through it on a PFIC statement in a given year, you're not able to take that loss. It's deferred until there's a redemption from the PFIC, and at that point it becomes part of your basis, so you'll get a capital loss. So while it's hung up as a deferred loss, if those portfolio deductions are large, ultimately you'll get the benefit as a capital loss when you redeem from the PFIC.
Right.
Yeah, but Vince, that's a good point. There are a number of trade-offs to the audience. Like it's not always a win. It's important to kind of look at those differences. I sort of liken it to investing in a mutual fund. It's kind of the similar result, right? So if you invest in a mutual fund and they have 30% drawdown that year, you don't get a 1099 with losses on it, right? You just get your dividends, and then you have to wait to recoup as a capital loss. So it does have that, and in a pass-through entity will pass through the current losses. So there's absolutely a trade-off to consider there.
And the other thing, Alex alluded to it, guys, but I can't stress enough the testing to ensure that you're not falling into the CFC regs is very specific. So you definitely need to enlist the help of a consultant when looking at that, because it's we do find situations where testing has been failed unbeknownst to groups where we come in and take over the books.
Yeah, absolutely true. One other just quick point on this slide here, where we're talking about really what we're talking about with this slide is the ability to deduct certain expenses with a corporation, and this portfolio deduction is when it's itemized deduction topic. It works both structures. So with high net worth families that are have a family office and sort of have all that goes along with that, which typically you see. There's centralized management. They're providing services to the family, including a lot of financial resources. There's often a entity that is employing people or paying advisors that the family funds, and that's sort of the family office manager, right? And they cover all the expense. Well, if you set up an investment portfolio run through investment funds, and that manager is providing services, you can actually structure it in a way that they earn a percentage of profit or carry from that investment portfolio to cover that overhead. And we mentioned that these miscellaneous itemized deductions are not deductible, and there are things like management fee, accounting, tax fee, advisory, legal, and so on that the funds are paying. Well, likewise, all those expenses that family office manager is paying for falls under that same category. So, overhead of a family office could be hundreds of thousands or often, millions of dollars. And to have all of that be non-deductible is, not great from a tax efficiency perspective. So if you can go to the structure, you have that manager earn an incentive and file a corporate tax return. And there's a number of special rules and things you have to do. And there has to be sort of a profit motive there, and generally some different ownership of that management company, where, perhaps a key employee, is a profit motive, or a share of profit from that management company. Then you can allocate income from the family to the manager, which reduces their taxable income. And then that manager entity has all these expenses which they can deduct. So you've effectively converted a large percentage of expenses, which otherwise would have been portfolio non-deductible, into just a reduction of taxable income to the family and then an expensing at the corporation. So it's commonly referred to as a family office structure. Smaller number of people that this might apply to, but for anybody that works with very high net worth families or anybody that is in a net worth family situation, that's often something that can save an awful lot on the tax efficiency side of things. Okay.
Great. I think we're ready for our first polling question. So in your years of practicing, what would you say the biggest mistake fund managers make on take matters? You can answer A, B, or C. Failing to diversify the fund's portfolio effectively, not keeping up to date with tax law changes, or over-investing in high-risk sectors without proper analysis. Everybody have a moment to put in their response.
I think we can move on.
All right, I think Zainab's got control. You want to take this one, Alex?
Oh, this is still the polling question, right?
Yes.
Sorry. So can we get to the next slide?
All right.
Okay. Yeah, so these are elections. I think both the other guys on the panel here can add something here. We spoke about wash sales earlier in tax efficiency, and looking at the portfolio before year end to figure out we can do some tax selling. Some trading strategies will generate like an immense amount of wash sales. You think about our sort of day trader type firms, and I think Ryan, the firm that you CFO for, had this strategy and used this election. You could probably speak to it at on a practical level, but if people are sort of just trading for the daily changes in price, the way that the rule works is if you sell a position at a loss, you can't reacquire it for 30 days. Like, you can imagine that if somebody's trading one stock and they're in and out of that thing 5 times in one day, and they do that all year, they're going to generate a tremendous amount of loss sales. So this election eliminates that risk. Sharon, do you want to let everybody know how that works?
Yeah, sure. So, you could end up in a horrible situation at year end that you fully didn't intend to get into, to where, you could be trading these same security just over and over. And as you know, those losses, there could be losses in given transactions, gains in the others, but you could get to the end of the year, and because of the washout rules, you could end up in a situation where you might be flat on the year, but you have millions of dollars in unrealized losses that are realized losses that are disallowed. So the 475 election will alleviate that situation. I've seen 1099s for the fund I work for, also clients of mine, where there's these large washout numbers on there. They fully didn't intend for that to happen, but to the washout rules, they end up with a large, essentially disallowed loss at the end of the year. So the 475 election, what that does is it'll essentially make everything mark to market at the close of the year, and everything's ordinary gain or loss. So there's no reason to perform any washout or straddle analysis. Essentially, your book income is your tax income.
Yeah, and then it's ordinary, right? So
yes,
go ahead,
Vince. Yeah, so I mean,
Yeah.
one thing to consider is before you make the election is, you know, what's your trading strategy? If you're buy and hold, you know, you could still end up in situations where you have wash sales, but it, you know, it's not as likely. But the big driver is if you think you're going to generate long-term capital gain, you don't want to make this election because you're going to lose the benefit of the long-term capital gain treatment.
Right, and if you are going to have kind of a split portfolio where you might have some, we'll call it investor type positions, other trading type positions, the IRS does allow you to designate separate accounts for 75F versus not commonly known or utilized, but something definitely that should be considered, because as Ryan and Alex said, when you get to the end of the year, no one wants to be in a loss position per se on their trading book, but if you are, that loss does come through as ordinary. It's not limited to the $3,000 against your ordinary income, so you could offset as much of your ordinary income coming from other sources, all sources, as that ordinary loss through the 475F election fund provides. Other thing, you can't do it if you're purely an investor fund. It's only an election that can be made by a trader fund that has some investor-like long-term cap gain portfolio holdings. And it's really important to look at and be very, very diligent about that separation, because in the worst case scenario, you could take long-term capital gains, turn them into short-term, in essence, capital gains because you're 475Fing them. And then now you've got ordinary gains because of the election. So.
Yeah, you should clearly identify those positions and segregate them before entering into those positions.
Yeah, I know that it can be done position too. We've always said set up separate sub accounts for that activity, just because we know how much traders like to, GPs like to specifically identify things as they're going in and out of the market throughout the day.
Good point.
I think one of the things that, you know, Ryan touched on it, he was saying how, you know, his firm or other clients that he's worked for, he's seen, you know, these large disallowed losses. I mean, you know, the magnitude of the number is can be eye-popping. Or, you know, he mentioned a fund that was flat. You know, you could have somebody trading $100 million in their fund and they're flat on the year. You know, they could have $50 million of gain or loss sale adjustments. And you know, it's this problem where you run into there's this technical rule, and you know, there's not much you can do about it. And just one other quick thing to highlight is the timing of making this election is very important. You know, if you are a fund that has this exposure or potential exposure to wash sales, and it's your first year, it's really important to, you know, look at things before year end, and you know, see if you're looking at a lot of wash sales, because you know, if you get past year end, there's really no way to make the election. So, you know, it could be a big problem.
Right, within the year you're electing for, it needs to be, is it 415 or is it the ultimate filing of the return? I think it's tied to like 415 or X number of days past 415, right?
Yeah, technically, you know, what you're supposed to do per the regulations is you're supposed to make the election the day you start trading, but the notification to the IRS, it needs to be with your originally filed return or extension. So Vince, that's probably the 415. It's 315 for partnerships, 415 for individuals or corps. You know, that would be you attaching that election to that return or that statement. And then, you know, there's a different timing. Sometimes funds are, you know, haven't made the 475 election and then they operate for a few years and then they realize they might benefit from it, or if the strategy changes, there's different timing if you're gonna make it for a fund that's a taxpayer that's are, you know, already in existence or already operating. So it's not too complicated, but just a few things to, you know, be aware of there.
Right. And irrevocable once you make it, so do not.
They did
Well,
actually
they changed that,
provide,
yeah.
they provide procedures. There's a revenue procedure there's a way to be able to revoke it. Originally it was irrevocable. You had to do a PLR request, but then they came out with a revenue procedure. I don't know if it's automatic, but it's easier to get out of than it used to be.
Got it.
Yeah, this next election here, this really relates to more relates more to the 9A1B election. It relates to like commodity traders and futures and forward traders. So basically, we're going to talk about 1256 a little bit later, but I'll just touch on it quickly. If you are somebody that's trading forward currencies and there is an equivalent regulated futures contract on that same pairing, you know, US dollar euro or something similar, you can make that election and get the same tax treatment as you would with 1256, which is 60% long-term, 40% short-term. So we're going to touch on that slide later, but you know, we'll go back to it. But I just wanted to mention what that was.
Yeah, and absent that election, the treatment would be ordinary income on those contracts.
Correct. Yeah, you're converting from ordinary income, which, you know, at highest marginal rate to this blended rate, which, you know, for a high rate taxpayer is still under 30%. So it's a definitely advantage there. Okay, so moving on to this next slide. So we discovered as we started this presentation, my apologies to the audience, that there are a few updates that didn't get uploaded into the slide that's here. So we're going to go through here, and then what we'll do is when we send this out, we'll make sure we attach the corrected slide. So the TCJA, you know, officially ended, but many of these provisions were replaced with the One Beautiful Bill Act. So the slide will have these updates, but I can just run through these and tell you how it translated. So the SALT cap, this is the provision where if you are an individual taxpayer and you're itemizing and filing Schedule A, you know, prior to the 2018 tax year, you could deduct any state and real estate taxes against income, and that was a valid deduction. Well, there was a cap put in place of $10,000. You could deduct anything in excess of that. So the revised bill, effective for 2025, is that the cap has been increased to 40,000 from 10,000. And you know, for people that are, you know, sort of you know, maybe not high net worth, but upper middle class, and you know, living in a state like California and New York that have high tax rates, like this is really hurting, you know, a lot of those folks. So the bump up to 40,000 should help quite a bit. The tax rates were set to expire and expand back to the pre-18 levels, but the One Big Beautiful Bill extended them so they're the same tax rates. There's no change to tax rates. Similarly, the standard deduction, the higher standard deduction was made permanent. There's an incremental increase for 2025. The miscellaneous itemized deductions, which are the portfolio deductions I spoke about, those are now permanent. They were set to sunset. And the one last thing that I wanted to point out here is that the other big change that was a big benefit was bonus depreciation. Was set to phase down, I think, to 20% in 2026. That's been bumped up to 100% again for 2025. So still a good year if you're a taxpayer that has a business and there's an ability to invest in anything that would you know, be good for the business, you'll get 100% deduction for the 25 tax year if it was placed in service after January 19th of 2025. Okay. So another tax strategy. This is one of the things that I think it's been out there a little while, and Vince, I'm curious. I don't know if you've seen any of your clients use this, or Ryan, if you've seen it. Like it's one of those things that like it seems a little odd. It's like a pretty good deal, and I don't see as much adoption as I would have expected. But I'm hearing a little bit more out there in the space. I mean, really what this is, for somebody that's a relatively high net worth and they have assets that they're concerned that they need to start doing estate planning, where they're going to potentially have assets that go to their heirs that exceed the lifetime exemption. If somebody's worth, $10 million, they'll be able to sort of leave all those assets and not have to be subject to estate tax. If you're worth 100 million, you don't have some good estate plan in place, there's, the IRS is going to get their hands on a chunk of that money. So the reason that this is a particularly helpful strategy is that life insurance that pays out on somebody's passing, death benefit, is not subject to tax. So what the insurance industry and the investment industry have done is come together to put a product together where you can essentially take some funds that you want to invest and invest it in a PPLI policy through an insurance dedicated fund where that it's a whole life policy, and that money is being managed in whatever hedge fund strategy that you choose, and growing hopefully at a good healthy rate, and then and no taxes paid on that income in the current year because those proceeds are just going back into the policy death benefit. And when that person that has that insurance policy does pass, all those proceeds go to the beneficiary tax free. So we're sort of making sure that we're putting this out there. We think it's really a pretty incredible estate planning and tax strategy. And we're also seeing our clients kind of develop some more of these products. So any hedge funds out there, if you kind of pair up with a PPLI insurance provider, get on their platform. You could bring, you could tell your investors that you already have in your hedge fund, or any RRAs are doing these things like for somebody that's concerned about estate planning and things like that, and having assets, leave their assets to their future generations. This could be a pretty valuable tool. So I guess I'll just ask you guys, have you guys see much of this, or is this pretty still on the fringe from your perspective?
I have not seen much at all, to be honest.
And I think there's just a couple of things that have kind of like kept it on the fringe, Alex. One, Tax Cut Jobs Act bumping up all those lifetime exemptions probably made it less of a need for probably the bigger component of potential investors and GPs. And then, besides the general stigma, just the long-term nature of like looking out like with these policies. And I think that kind of scared away some of the early adopters for how far out you had to look, for some of those early policies that they were crafting. So same as Ryan, still seeing it just more on the fringe for the hedge funds that we're talking with.
Yeah, I mean, good points. I mean, to be fair, this probably isn't that attractive until, somebody has an estate that's worth, I would guess, I'm not an estate planner or attorney or anything, but I would think that, we're talking probably north of 50 million before it starts to become attractive. And then, you start making a long-term commitment, right? You might say like, oh, I'm going to take 5 million and kind of put this policy for my grandchildren, grandchildren's trust insurance plan kind of thing. And, well, that's got to stay there, right?
Yes.
It's like, that money's gone, like, so you've really committed to it. So to your point, it's fairly permanent. So anyway, just wanted to kind of bring that up. It is a good tax and estate planning tool for the folks that it would benefit. Okay, we can move on.
All right. Just for the sake of time too, I'm just going to run this really quickly. Next polling question. Is there anything you think is a must-do when it comes to tax preparation for funds? A, preparing detailed itemized expense reports, conducting a thorough review of each investor's tax residency status, or ensuring compliance with all IRS filing deadlines? You can submit your answer. That would be great. A second there. All right, I'll turn it back over to Alex. You taking the next one?
What's the next slide?
There we go.
Oh, actually, I think Vince, you're gonna kick this one off, right? And then I'll see if I have anything else to add. Is that right?
Yeah, sure. Yeah. I think you touched on just book basis, tax basis a little bit earlier, and we always want to look at a file that's going to give us not just book income, taxable income to know which investors might be a little concerned, but basis is also important, but it's exceptionally important for the GP because the GPs are typically going to have a lower basis if they have been receiving carry. They're typically not going to be increasing that basis with a lot of taxable income. It will follow the taxable income in general of the partnership itself. So if the GP is taking distributions, recognize that you could wind up in a situation that they call distributions in excess of your tax basis, which require you to pay tax on the delta between where your tax basis hit zero and what that distribution amount was. Now there is the opportunity if the fund does have liabilities, and those liabilities are allocated and of a certain quality to the GP, that you can kind of shelter those distributions in excess of basis. But there are, again, rules and regs that you got to follow for whether or not some of those liabilities need to go beyond the GP. And so planning is definitely needed here. But most importantly, just thinking about timing of GP redemptions, and if those can be pushed out into the following year, would essentially mitigate this at least for a single year, but then you would get the benefit of taxable income increasing your tax basis for the GP in the following year, should we wind up with both book and taxable income. I know I ran through that real quick, guys, but anything to add?
Yeah, no, I think you nailed it quickly. I mean, I'll just follow up with, or reiterate, I guess, that, if you want to pull capital out and you're a manager, kind of look closely at, what's your basis situation. You probably need to check with your tax return preparer and think about, are you triggering gain unnecessarily? The other thing is if you have funds in your LP, if a lot of these managers will have, funds available to them and the general partner as they earn the incentive, and then they also personally invested. I've seen where managers will say like, oh, I'm up in my GP account, I'm going to pull some money because I have to pay taxes and I want to move it around or do whatever. And, they're sitting on $5 million on the as an LP investor, and like, well, how much will pull out of the GP? $1 million. Why don't you just redeem $1 million as an LP, because that has basis and you're not going to incur tax. So just a simple way around that. The suggestion you gave about waiting until the next, Q1 and a Q1 of the next year is a good one. But then also just, maybe pull some from your LP account. It's likely to generate less of a gain for you. Okay.
Totally.
We alluded to this earlier. I think, Ryan, you were going to give an overview, or can you help?
Yeah. So as we touched on this earlier, so there's not much more here other than, any futures options or broad-based index options do get afforded Section 1256 treatment. So, some of these things, like a lot of people sometimes will miss these broad-based index options, but just know that, they do receive Section 1256 treatment, which is beneficial. So with Section 1256, like we touched on, it's mark to market at year end and treated as though it was the contract or the position was closed at year end. So you realize the gain or loss on those contracts. That basis is adjusted in the contracts going forward. And then the benefit of, because you're recognizing gain on those contracts, the benefit is you get the, beneficial 60/40 treatment. So any gain or loss, for that matter, on a Section 1256 treatment, you get 60% long-term capital gain treatment and 40% short-term capital gain treatment. And then, like I think we touched on earlier when we went through the 988A1B election, the exception is any foreign currency contracts. They get, unless you make that 988A1B election, they're mark to market and they're treated as ordinary.
The one quick thing I'd like to add is that, if we just look at this, what we copied here, what's included as any Section 1256 contract, we've identified these things. There are certain products in here that are considered technically a 1256 contract, but won't necessarily receive 60/40 capital gain treatment. And then certain things sound like they're one of these things, they're actually not. And I'll clarify a little bit. The non-equity option, we talk about options on broad-based indices. Well, I see kind of all the time where taxpayers think that, like, oh, I have an option on the S&P 500, is at 1256. Well, if it's an option on the S&P 500 and it happens to be traded on an appropriate exchange, then yes, it's 1256. But if you have an option on an ETF that if you exercise it, you get shares of the ETF, that doesn't qualify, right? So, there's other characteristics like, is it cash settled, or could you exercise it and receive an underlying share of an ETF? It's not going to qualify. And then some of the foreign currency contracts, while subject treated as a 1256, they may receive ordinary treatment, which was the purpose of that 98A1B legend. So, the sort of takeaway there is, if you're trading some of these things and you want to confirm the tax treatment, is, you just check with your tax preparer to confirm it actually is going to get that treatment. Okay.
Great. Third question, how do you manage investors' concerns of receiving K-1s later in the year? A, by providing estimates in advance and delivering K-1s promptly after tax season. B, by issuing K-1s early in the year to meet investor expectations. Or C, by including K-1s with quarterly earnings reports. So please enter your answer into the poll on how you manage this today. And we'll keep moving on. So now we're out of hedge funds and moving into management company. Considerations. All right.
All right. So yeah, before we get into some of these here, there's a couple of other really simple things I can touch on that kind of what we see big mistakes or misperceptions that the principals of management companies and GPs will typically make when they're setting things up. The first is around, do I get a W-2 when do I start my payroll and being able to take salary, and what you got to remember is, as a principal, as a partner of a management company, you're going to receive a K-1, and that K-1 is going to govern all the economics of the relationship that you have based upon the LLC agreement or LP agreement. And so you're typically you can set up a salary-like draw, which will be deemed guaranteed payments and taxed similar to ordinary income that you would typically receive as a W-2. Managers will typically then say, well, what about health insurance? What about 401k plan? What about, all these different things? And receiving a K-1 with guaranteed payments will afford you the ability to have all those things that you would as a W-2 employee. A couple of additional things to add there. One, if you have an S corp, typically you can split and have payrolled principals, partners of the S corp that also receive a K-1 to get their distributable share of earnings. And then two, if you use a PEO, professional employer organization, because the PEO's tax ID number is typically on your, on a W-2 or on a filing that you might receive, you could also set up a payroll within a PEO relationship. If, let's say, you have 10 team members, 2 partners, the partners could also be W-2s of the joint payroll provider while also being K-1'd. We don't like that setup, but it's okay. I haven't seen one tested by the IRS yet because you technically do have that joint relationship with the PEO. But I have seen lots of unwindings of earlier year tax returns because GPs set themselves up as W-2 employees within the management company, and the IRS has come in and said, nope, go back, refile. And now you're not just refiling, you're paying tax through a different mechanism, quarterly estimated payments versus W-2 withholding. And you say, but you have my money. And they say, no, we'll send you back your money when we get to it. You owe us money, and we're going to start charging interest and penalties and things of that nature. So very important to just make sure you got that squared away with the right tax advisors when you're starting out and when you're adding new members to the Manco. Another thing, I talked a little bit about 401k earlier. You do have the ability to sock away a lot of tax saved earnings through 401k plans, cash balance plans, and defined contribution plans. But again, that's going to require you to do some significant planning, usually looking out at least 3 to 7 years, because you're using actuaries to set things up. But you can afford yourself far in excess of the I forget what it is this year, Alex, depending upon age brackets that you could put in a 401k plan. But we're talking about hundreds of thousands to millions of dollars that you could put away tax deferred versus the tens of thousands with just a straight plain vanilla 401k plan. So another thing to consider when you're teeing up your management company. And if we forward one page, I'll get into the PTE tax that Alex had alluded to earlier when talking about the SALT tax. So the pass-through entity tax. Let's go one page more, Anna, because actually let's set up the actual what we're doing with the tax itself. So Alex mentioned the SALT tax, which the Tax Cut Jobs Act of 2017 limited what someone could take as an itemized deduction on their individual tax return to $10,000. Because of that, lots of states who had some regulations on the books for state taxes had the GPs and the principals shift their focus on paying state tax from their individual tax return to a pass-through entity that they might be a party to. It didn't count for certain types of businesses, but managing a private investment fund, you were afforded the ability to actually pay some of your state income taxes through your management company and then receive a credit as an individual, thereby going far in excess of your particular limit of $10,000 on your itemized deduction. So as Alex mentioned, that has gone up with the big beautiful bill to $40,000. However, it starts to get phased out at $500,000, and it phases out completely at $600,000 because they've got a mechanism where for that 100,000, for every dollar above 500, 30% goes away, and so 100,000 equals 30,000. 40,000 minus 30,000 equals 10,000. So for a high income earners, you're going to phase out of that. So you shouldn't just forget about the PTE tax for 2025 and beyond. Really important to note that state rules do differ, most importantly in the timing of when you need to actually determine what tax is being paid. Think the typical offenders, New York and California. You got to be really clear about declaring and making payments on these types of taxes. Again, takes some planning and even some, which way is the wind blowing, through the remainder of the year. And so just make sure that you're doing some well thought out planning with your tax advisors when you're doing this. If we go back to the prior page, you'll see in 2020 the IRS did put out a proposal in a notice that there was a lot of, is this going to be, are we going to be looked at askance? Is the IRS going to come back and disqualify what we've done here? Can we keep doing it further? And the IRS said, look, we're gonna essentially give you the ability to do these types of pass-through entity tax deductions and credits to your individual return. It's important to note they actually never fully implemented the proposed regulations, but you're able to follow the proposed regulations and should be using this into the future. I will say what we don't see a lot anymore, Alex, Ryan, I'm not sure if you guys see it different. There was a lot of talk around the funds themselves, the hedge fund themselves, the private equity fund themselves, also having the ability, because they're a pass-through entity, to do this, but there are so many complex, difficult considerations to consider because you've got conflicting interest, right, between the LPs, the GP, some GPs as LP, and then if you do pass this through, are you dinging capital? Are you dinging the income statement? is carry being affected by it. So there's some complexities there, but I still think it's worth looking into at the fund level just as much as the Manco.
Yeah, awesome summary, Vince. I'll just add a couple quick comments here. We're getting close to the end. I mean, I think the PTET regime, if you are a taxpayer in a high tax state that offers this, is like, it's a no-brainer. Like, it's free money. Some of these other strategies we talked about might be timing, like tax law selling or things like this. Is a permanent change in tax rate. For a New York City high net worth person that is able to benefit from PTET, like, all the things being equal, it's like a high level, but it's like a 3 to 3.5% benefit to them on income they earn, like dollars in their pocket. So what that means is, if they make $100,000 subject to New York City taxation and they are able to put that through PTET, they're going to save $3,500. Put that up to $1 million, it's 35 grand. 10 million, it's 350,000. Like, these are big numbers.
Real money.
So like, you should do it. First of all, it's free money. But there are the complications. Just quickly on the fund side of things. I mean, attorneys get nervous. Like, does the document allow us to do it? Not every partner is taxable in the state. Like, there's a lot of complications there, I think, that make it practically difficult. I think that, management companies, a no-brainer, always do it. GP entity, probably 80% of that answer. Like, sometimes it gets a little complicated depending on who they are, but try to do it the GP entity. Down to the fund, I've seen very few funds that have felt like it made sense for them, unless it was like closely held or, some other.
Right. Funds of one, different things. Yep.
Yeah, a family office, or, people that, are like, you have a very close kind of connection with the people. If they're third-party investors, I think it's practically, it's pretty difficult to make it work, just based on my experience.
Yeah, I've never seen it done in a fund situation.
Yeah, so I think we're pretty well out of time.
We are. I'm gonna just do one last. I think we had one last maybe poll question here. What should be considered? What's that?
Is that okay?
Yes. Okay, great. What should be considered to avoid double paying state taxes when using the PTE tax credit, which we talked quite a bit about? A, reduce individual state tax payments by the PTE tax credit amount. B, increase quarterly tax remittances. Or C, exclude capital losses from the PTE tax base. So please enter your answer into the poll. And that is a wrap. So we will, as Alex had mentioned, we're going to send out this deck to everyone that attended. If you have any questions, please feel free to reach out to us. You can see our email address there, as well as our toll-free number. And we'll also publish this on our YouTube channel. So feel free to watch it again if there's anything that was of more interest, but very much appreciate everybody joining. And just a quick reminder, 6 weeks before the end of the year, right? So if there are any things you haven't thought about or anything kind of sparked some interest, you've got these great experts here, and we're happy to connect you to, Alex, Ryan, or Vincent. So thank you everyone again for joining, and we will see you likely after the new year. Thank you so much.
Thanks, guys.
Bye.
Thank you.